All right, what is up, traders? What's up, Tycoon? Super excited for today's video. We got another Tycoon talk. Lots of important data that we're going to go over, a lot of interesting charts as well. We're going to break everything down today with our guest, Tycoon Leon. Now, as always, the content provided on this channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. Myself and any individuals that appear on this YouTube channel are not registered financial advisors or brokers. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer, okay? And if you guys want to help support the channel out, what you guys can do is you guys can use, the links in the pinned comment below or the description below, or you can email me at zackleytrades@gmail.com for a one-on-one coaching session. You can also email Leon. Leon, if you want to give them your email real quick to reach out for them in case they want to do a coaching session with you.
Okay, that's going to be apolonenterprises@gmail.com. APOLON enterprises@gmail.com.
All right, cool. Well, there we go. And we'll go ahead and hop right into it. And something crazy right now, okay, tech is valued at a 37% premium to the market. And the only moment where tech was more expensive relative to the market was between 1999 and 2001. And we all know about the famous 2000.com bubble. So, really, really interesting perspective right now. Now these gray shaded areas, these are recessions. But if you see, again, we're seeing tech really valued at a 37% premium to the market relative to everything else. And we really haven't seen this since the last time we had a major bubble in the market of the .com. So we're going to touch on some of the, things that are very similar to the bubble. If you take a look, the S&P is being completely driven by the top 5 stocks. Okay. And these top 5 stocks are going to be Apple, Microsoft, Amazon, Nvidia, and Google. And that's what we have here in the white line. So if you look since January, the top 5 stocks have been killing it, absolutely crushing it. And if you look at the mean return of the remaining stocks, okay, so the other 495 stocks in the S&P, it does not look good. It's actually been in a downtrend since February, late January. Meanwhile, the market has completely exploded. And it's all from tech, guys. It's really just the AI boom right now. And tech is driving the market. Now, what's really interesting, okay, if you look at the net retail purchases of AI-sensitive stocks, the net retail flow is actually not that bullish, okay? It really hasn't been increasing very much. If you see, it's actually more in a downtrend. And this is the bots ETF right here, which I did do a video on bots. I've done a few videos on bots actually, but it's basically the AI ETF. And you can see that this thing has just been absolutely, skyrocketing. Meanwhile, net retail inflows and purchases really aren't following along. So, it goes to show that most of this is institutional, right? And they're rotating. And a lot of time, these institutions and hedge funds, what they do is they follow what's working. They have clients calling them, hey, why aren't we buying NVIDIA, right? We just saw what they did on earnings. Why aren't we in this stock? Why aren't we in this stock? And then so they have to do kind of what their clients are telling them to do. So that way, they can secure the clients and not lose the clients, right? They don't want to get fired. And AI is just what's hot. It's what's working right now. We're seeing lots of inflows into that. But if we take a look here, okay, and this is the price to sales ratios of the top companies, the top bubbles, the top stocks in the 2000 bubble, right? So this is 2000 right here. And what I want to show you guys is Cisco led the way there, okay? And their price to sales ratio was 38.92. All right, that was the peak of the bubble. Insane price to sales ratio. Look at NVIDIA right now. And this actually just came down, bro. It's at 37.92 as of June 2nd. It was even higher just before that. So I'm sure it crossed above 38. So again, we look at the .com bubble. 38.92 was the peak. NVIDIA's right there, guys. NVIDIA is right there at the peak of the prior bubble of the .com bubble. So, you can look at this 2 ways. I mean, yeah, maybe NVIDIA is really worth this much, or maybe this is a big warning sign, right? A lot of the attention is solely focused on NVIDIA. If we take a look at some of the other top AI companies out there, you have Alphabet, okay, which is Google, right? They have Google Bard, all right? And look at their price to sales ratio. It's at 5.7. Microsoft, right, which owns the majority stake of ChatGPT, is at a 12 PS ratio, price to sales ratio. So completely different from NVIDIA. And if NVIDIA starts to give this stuff back, we could really actually be due for a pretty big pullback in the market. Now, some important data when it comes to the pre-election year and aggregate cycle seasonal patterns from 1949 to now. we're basically in this cool off period here right now. So you can see heading into the summer, essentially, we do typically have a rally, right? And 2023 is going to be this purple line right here. And so we can see the market has been actually rallying, all right, since the beginning of the year. And you know, we go into this normal consolidation period, right? We're right here in June now. And this is when things start to get a little bit more choppy. And if you look at June, that's kind of where we end up bottoming out at. The top of June right here is where we kind of bottom out in October, November. So, you know, we could see flat returns on the market over the next quarter or two. And that really wouldn't surprise a lot of people after, you know, the really, really big gains. I mean, it does suggest that June and July still could have a little bit more momentum and we could trend a little bit higher if you go by strictly this data right here. But ultimately, what I'm looking at is actually towards the end of the year, right? In Q4, we tend to see a pretty strong boost, and that's right after you know, those election times right here is right around November. So we're going to see if this can continue. You know, history doesn't have to repeat itself, but if it does, this can help give us a little bit of context into the market moving forward. Now, something else that's been a really, really big topic is the debt ceiling, okay? And so we can take a look at here at the S&P 500 performance before and after the federal debt limit change since 1950. And so the black line is going to be since 1950, the red line is going to be since 1980, and the blue line is going to be since 1990. And so we can see historically before and after since 1950, the market's pretty much just gone straight up. But if you look at more recent times, since 1980 and 1990, it actually has become more of a sell the news event, right? And we see that once we actually get the limit changed, we actually get this period where the market starts to pull back for the next 15 to 20 days. And so that's going to be really important to a lot of people right now, because if that pattern is going to repeat itself, we could be due for, you know, a drop, whether it's a very large, significant drop or a smaller drop. That's something that a lot of people may not be prepared for. They're thinking, hey, the debt ceiling got passed. Now it's to the moon. And maybe since 1950, it's been, oh, hey, we're going to go to the moon now. But more recently, okay, in the past 40 years or so, we see that the market actually sells off and it becomes a sell the news event. And then we start to see the market recover afterwards. So a little bit of data to kind of perhaps back this up. We have the S&P 500 here, right? And this is going to be on the top chart. Okay. And what we can see is we have the percentage of stocks above their 200-day moving average and the percentage of stocks above their 50-day moving average. And whenever we see divergence in these, typically the stock market tends to follow what's happening on the percentage of stocks following the 200 or 50-day moving average. For instance, if we look at this example in the past, of around September of last year, September and October, we saw the S&P 500 creating lower lows. Meanwhile, the 200-day moving average, the percentage of stocks above their 200-day moving average, were actually making higher lows at that time period. And sure enough, the stock market actually followed and rallied shortly afterwards, right? Same thing here on the percentage of stocks trading above their 50-day moving average. Now over here, what we can see is we actually could start creating these higher highs. And at this point on the chart, all right, right around there in that December, late November to early January time period, we see that, you know, the percentage of stocks above their 50-day moving average is actually in a downtrend, making lower highs while the S&P is making higher highs. And then we see a nice sharp pullback there. All right. If we look, that's from about the close to the 4,200 range all the way down to the 3,900 range. So, you know, about a $250 to $300 or 300 point drop after that divergence. And if we take a look currently on the 200-day percentage of stocks above their 200-day, we're in a very large divergence now where, you know, we've been creating these higher highs right now on the S&P 500 for a very long time. We're creating these lower highs here on the percentage of stocks above their 200-day moving average. We're creating these lower highs here on the percentage of stocks above their 50-day moving average. And if these divergences tend to play out where we see them follow the percentage of stocks above their moving averages, we could be due for a pullback in the market. And we kind of already highlighted that in the beginning, that the whole market is really being driven by the top 5 stocks, and the rest of them are actually not performing as well. So, you know, maybe that's a big warning sign. Leon, if you want to take over right now, I could go ahead and share the screen with you guys.
Oh yeah, sure. Let me hop in there real quick. Oh, you gotta Prove me. Sisman.
All right. So, all right, there we go.
Yep. All right. So what we're looking at is the /ES, which is the S&P 500 futures. And as you can see, when we go from the high of 4808 to the low that we hit back in October and bounced that, everybody's like, oh my gosh, it's a bull market. Like, you know, we're here. You know, Apple is up 40 something percent, you know, for the year. Nvidia is up like over 100%. But when we look at this a little closer, all we did was tap that 61.8% retracement. Now, what does that mean? That level is like called the golden pocket between the 50% and the 61.8% retracement. Usually, stocks come back, hit that 61.8% retracement, and then they fall. If you follow Elliott waves, that 61.8% retracement is very important as well. But that's just showing me whatever
Definitely.
you want to call it. If you want to call it a bear pennant, if you want to call it, some people are calling it a volatility contracting pattern, which they think it's just going to, if you look on the weekly, they think it's a VCP pattern, which is like it's just going to kind of grind up to go to all-time highs. When I look at this on the monthly, I'm looking at it's going to drop. And I've
heard people calling that the Nike swoosh as well.
Right. Right. And I've been saying if you know /ES or SPX gets above like 43.25 comfortably, then we can go to all-time highs this year. So if we can comfortably get above 43.25, then and stay above there, we're probably going to all-time highs, maybe even like 5,000 this year. But I don't think we're going to do that simply because of everything that's going on. What Zach mentioned as far as the, you know, in the government, like the T-bills that are going to be released on Monday, it's like 123 billion or 120 something $billion.
That's going to suck out a lot of liquidity.
Right. And it's going to suck out a lot of liquidity. This is one day. This is one auction. They're auctioning off $1 trillion over the month of June. From the beginning of June, from Monday to the end of June, they're going to do $1 trillion, and over 120 something billion is going to be auctioned off on Monday. So when we look at what's going to cause us to get that, you know, those all-time highs, like I don't think we're going to get there simply because of what is pushing the market. As you said, maybe just a couple of stocks that are pushing it. Also the defensive sectors like, you know, healthcare, utilities, you know, the flashing red lights when you see a possible recession coming, that is what's happening. So when I look at another chart, I'm gonna go down.
Yeah, and it's really interesting. We're right there at that 61.8% retracement from the highs to the lows. That's where a lot of people start targeting, you know, either longs or shorts is right in that area.
And when I go down to this weekly chart, what we're looking at is basically in the yellow and in the purple, I have like areas of liquidity. So this is like smart money setup, you know, inducements. A lot of people call them different things, but we utilize at Options Trading Tycoons everything that we learn and simplify it to make it simple complexity where you can understand it. We're not going to say, hey, you know, your securities. No, we're just going to give you the easiest way to understand it. So what happened is these yellow areas of liquidity that I'm pointing out, it came back and retested those areas of liquidity and dropped. So when you see that, boom, it tested that, came back and dropped, made a higher low, boom, tested that area of liquidity, made a higher low, and it was going to come touch this area of liquidity, boom, touch that, and that is actually where we are for the 61.8% retracement. We're going to come right back down here to 3,500 and then drop below there. And as you can see over here, I have kind of an example of how that works out. So this is what you can pretty much see playing out right now. That valid point of interest at the top is where we're at right now. And if you look at the stochastics, we are forming a bearish divergence if we do get a drop this week. So this is the weekly chart. We get a drop this week, it's going to form a bearish divergence on the weekly chart for the S&P 500 futures, and we already know what's going to go down from there. So when we look at another, let me see what I put it on. Boom. So when we look at another chart and see it from a different perspective, a lot of people know this market psychology or market cycle chart that I'm showing right here. A lot of people know that. They think that we are in somewhere over here.
They think we're in like hope and disbelief and stuff.
Hope and disbelief and optimism. We are definitely not. What you can see, actually, let me pull it up a little closer so it can, yeah. All right. What you can definitely see is we are in complacency.
Yeah.
That's exactly where we are. Now, where I said we would possibly drop right here to 35, that's the October low. We're going to take that out. We're going to take that out and go to anxiety. So all of this optimism in the market, it's going to flash like probably this week. I'm pretty sure this week, if not, soon. But once again, over 43.25, I'm flipping to, we can go to all-time highs. But for right now, this is what I'm saying. Anxiety is coming around like 3,200. And as you can see, it's going to be denial. We're going to drop off from there. And this has happened before. 2011 for me is the best possible comparison. So if I scroll to let me see if I can, let me go to the weekly chart. So if we scroll over to 2011, you'll see the best possible comparison right here. All right. So yeah, where is it? All right, boom. Best possible comparison right here. So around here, June or July, that's when the bill was passed for the debt ceiling. All right.
Yes, yeah.
That's
I
when it
was
was
gonna say
passed.
that's one of the best examples because the market dropped a bunch. I think it dropped like 20% after the debt ceiling. It turned into a sell the news event.
Right. I think it was pretty much right here on this candle, like the June 18th is when they were talking about like, passing it. And then around July 18th and then July 25th, I believe that's when it happened. And then we dropped from there all the way down for the next 3 weeks, which was like a 20% drop.
Yep.
All right. So literally, like you'll see, I think August 1st, something happened as far as like they didn't know. I have the timeline in the Discord, but they didn't really know when they would run out of money, basically. But they don't have to know it now because we passed the debt ceiling. But like all of those things were coming out after the drop, I believe.
And so that's the weekly time frame, and that was basically like 2 candles that did that. And that chart that I showed you guys in the beginning of the video, that showed that since 1980, the debt ceiling has actually become, a sell the news event. And it showed that like, 15 to 20 days out, we typically see the market drop after the debt ceiling, after a change in the debt ceiling. So, especially when you compare that to 2011, and, the market right now, it definitely seems like that could be possible, and that could be a possible scenario. We have lots of, bearish divergences across the market through different internals, such as those moving averages. If you look at, you compare SPX to TLT, there's a divergence there, SPX to HYG, the high yield corporate bonds, even the junk bonds, and just a lot of different things. We're seeing a lot of reasons to be cautious in the market right now.
And also, piggybacking off of that, so we literally got that sell off 20%. Now, what happened along with that sell off is Standard and Poor's, or S&P, downgraded the credit rating for America. Basically, like they downgraded the credit rating from a AAA to, I think it was A+ or something like that, and a couple of other, it was a couple other downgrades for the credit rating for America. So that happened around the same time, within like a 2-week span of when the debt ceiling was passed in 2011, like maybe a week or two later, those downgrades happened for the first time ever, by the way. First time in hundreds of years, like ever. And keep in mind, when we look at the debt ceiling keeps rising because we have never been on the positive side of credit as a country, which is kind of wild to me, but fact check me. It was only 2 years when Andrew Jackson paid off all of the debt for, the United States, and we were debt free for 2 years. We have been raising the debt ceiling for like 200 years or more. Like literally, we have been in debt. This is probably the most, of course, debt that we've been in. But yeah, it's what I'm saying is a lot of people are having this gloom and doom attitude. It's just how we operate right now. So capitalize while you can. So when we look at these SPX, You see all these red highlights? This is my special one. We literally have all of those gaps from 2020. Now, if you know gaps in the market, they always fill. I don't care what anybody else says. I don't care what any analyst is going to tell you. They're like, gaps in the market always fill. I'm pretty sure if you look at it far enough on the far enough time span, you'll see where it filled at. So these gaps are going to fill. I know a lot of videos that, Zach has been posting say we could get a recession in 2024. That's a possibility because with these T-bills, $1 trillion once again in June, like we could get a sell-off where we're looking at the Wyckoff scenario right here. This is we're in phase B right now, going into phase C to go into the spring area, okay? Now, if you know the Wyckoff methodology, it's just like, the cycles of the market. We're going to see the same cycles on different time periods. This is basically telling us when we fall into the spring around that level for anxiety that I was showing you, then we possibly could bounce and go a little higher. I think, though, if we do bounce, it won't be to go to all-time highs. I will reassess if that does happen, but it might play into what Zach is talking about as far as getting the hype and going higher, but eventually selling off in 2024 for a possible recession. I'm leaning towards us not actually bouncing for this Wyckoff accumulation scenario. I'm leaning towards the Wyckoff redistribution. So if you look down here, the lowest gap that we have is around like 2,200. So that's going to get filled, ladies and gentlemen. Like, I don't know if I'm not trying to spook anybody, but everybody is, so positive about the market and nothing is how it's supposed to be, which this has been a historic 3 years, but just understand that there are like 20 or less stocks pushing everything up. It's being held up on paper cups. So if you want to make money, just look at both ways, not just bullish to the moon. So when we look at that other scenario, as far as the Wyckoff reaccumulation, redistribution, what we're looking at here is the spring happened at that high, at the all-time highs. That was the spring. And then this is the breakdown right here. It might look like a head and shoulders to a lot of people. So when I look at it, I'm like, you know what? Looks like a head and shoulders. But when I look a little deeper into it, this is why all the knowledge that you have comes into play. Oh, boom, we came up here and we broke the head and shoulders. Nah, it's not a head and shoulders. It's a redistribution scenario. So that's called the throwback. The throwback bounced off of that 50 SMA that's in yellow and dropped. Bounced off of the 200 SMA and is currently creating the correction, which, as we saw on the monthly chart, is stopping at the 61.8% retracement. So whether we go with the Wyckoff accumulation scenario or whether we go with the, market cycles with the complacency, or whether we go with the Wyckoff redistribution scenario, it's all telling us, hey, we get above this level right here, all-time highs, baby. Like, we get above that, we're pretty much good. But if we don't, it's gonna be a rough trip down. So the Wyckoff redistribution, what happens is we don't stop at this area that I mentioned on accumulation. We drop all the way down here, baby, and then we drop lower than that. And then I want to show you just a brief example of what the Wyckoff accumulation is. So this was the first chart that I showed you where the spring would happen below that secondary test level. That secondary test is around 3,500 for October, the October lows. This is why I'm saying we're going to break those. That will cause the spring. But if you look at the redistribution, what we're looking at right now, all right, let me actually pull that out a little bit so it can look a little better. All right. So when we look at this and compare, this is going to drop into the redistribution level right around where we have the bottom gaps, around 2,200, 2,500. That's where it's going to drop at. All right. And then we're going to get another accumulation, Wyckoff accumulation, that's going to rev us up sideways, go, consolidate for a couple of weeks, maybe a couple of months. Boom, head off into a bull market. So if you're one of those people that only look up and don't look down. We look both ways before we cross the street around, in option trading tycoons, because we want to be able to get to the other side because it's a bag over on the other side. So if you're able to make money all the way down and everybody else in their retirement account and they didn't take money out, and how Zach is telling you how you can sell, covered calls and things of that nature. Like if you didn't make your money on the way down, when we get down to that Wyckoff accumulation area, where people didn't think it was going to get down to the 2200s or 2300s, you're going to have a lot of money to reinvest into the market, and it's literally a life-changing thing. So that's one of the things I want to talk about. I'm going to go into a few stocks. Is that okay?
Yeah.
Okay, so we're going to go into Apple right now. I got to coordinate with my phone as well. Matter of fact, yeah. So we're going to go into, no, matter of fact, I want to go into VIX. VIX is really important. So VIX, when we look at VIX right here, it's the volatility index. So volatility, the VIX goes the opposite way of the market. So when the market is going up, VIX is going down, which is what happened over the last 2 days. Thursday, VIX dropped over 12%, which is crazy. And then Friday, VIX dropped almost 10%.
7.
Yeah, 7 or something like that. I didn't see the final count, but within the last 2 trading days, VIX dropped almost 20%. It's crazy. That never happens, right? Now, once again, when you look at what's pushing it up, you'll realize, it's a fool's rally. Now, when we look at that Wyckoff that we were talking about earlier, I have this that was in our Discord, and it was around this area when I drew it. We didn't even drop yet, so we actually fell into the spring right here. I'm going to pull that up again just to kind of compare. We fell into the spring right there. So that area that I'm talking about, that's the spring. Now, once again, we use everything that we know in the market. So one of Zach's favorite patterns is the bump and run. This is an inverse.
Baby. That's my baby right there.
This is an inverse bump and run. So when you look at the inverse bump and run, and then you're looking at the 4-hour time frame, okay, it's looking like we're going to bounce on VIX. Once we break that trend line, let's go down to the 1-hour trend line, 1-hour chart. 1-hour chart, boom, we have a bullish divergence. All right, so we got a bullish divergence right here. Boom, bullish divergence on VIX. All right, I'm pulling it out so you can kind of see it a little better. But boom, so we're looking at the 1-hour time frame, and we're like, are we like just calling the unicorn or like crying wolf? No, it's a bullish divergence on the 1-hour time frame.
Zoom in on those past couple days so we can explain to people what bullish divergence is. Show them how it's the lower lows and the higher lows.
So when you see a higher low, let me actually remove that real quick. So when you see the indicator is supposed to go exactly as you see the candlesticks on the chart. Whenever you see the indicator like stochastics going the opposite way of the price action on the chart, that's a divergence. It's diverging. Now, however they set up, they mean different things. So what I do is I go from either the highs, like the tops, or the bottoms. All right. So the bottoms, this is lower, this is lower, this is lower. The bottoms,
so lower lows.
And lower lows. This is a lower low, then a higher low, then a higher low. It's telling us that we want to go outside. We want to run a little bit. So once it breaks this trend line on the 1 hour, I like to look at the lower time frames because it helps you. And then on the bigger time frames, like the 4 hour, you sustain your move. So you're not like looking at the 2-minute chart. You have a nice, healthy amount of money that you can make. So on this 4-hour time frame, it's showing us on the 1 hour, we're gonna break this trend line.
Now for VIX, go to the weekly time frame real quick, and I want to show we haven't seen this low on the VIX in years. If you zoom out a little bit, we haven't been this low. Look, 14.1. That was back in 2021. You know what I mean? The VIX hasn't been this low in forever, dude. In literally years, the VIX hasn't been this low. And if you go to the option chain real quick on for VIX, and take a look at those, and go to the what's it called here? To like June, go to like no, June 21st, or July 21st. Yeah, look at June. Look at this open interest, bro. It's all six figures. 140K, 100K, 172K, 200K, 200,000, 200, like it's huge, bro. It's all massive, massive,
Now keep
massive.
in mind, open interest and volume. Now volume, okay. I got the perfect analogy. You ever been trying to get into the club? Like volume is the people that are in line trying to get into the club.
Okay, I like this
Open
analogy.
open interest,
Is how
they
many
are
people in the club?
already in the club. They already in VIP. They already done
That's,
had two
dude,
drinks.
that's such a fire analogy.
Open interest, they already got their ticket and they're already inside the club. So these are actual individuals holding contracts. It's not like,
Bro, 300K, bro, at the 30 strike.
we're looking at millions of contracts that are of what, like the strike 20? It starts at 20. It starts at 20. We're at 14. You know what I'm saying? So when we look at the open interest, hey, that's crazy, by the way. I didn't even look at the open interest. That's
Those are the ones I'm in. So yeah, full disclosure,
that's
I'm in June
crazy.
21st call options on the VIX. I have the I think 17 strike or something below 20. I have below 20. I know that for sure. I don't remember
Now
off the top of my head.
watch how this falls in line. So when I go to the 4 hour chart and I look at that Wyckoff that we said that we actually, fell into the spring, and then we looked at this is a perfect inverse bump and
Bump and
run,
run.
which is a bullish pattern. And then we have, if you look closer, the two gaps right here. Boom, we got the two gaps right there. We're gonna probably go above those gaps. You see the target area I have for liquidity will probably stick there like a magnet. You know what I'm saying? That's that target area. Where is it around? 20. It's around 20. But when you look at the Wyckoff setup that we talked about, the Wyckoff is just the spring telling you it's going to go higher. So when you see the 30 strike, the 28 strike, the 26 strike, 24, everything above 20 on VIX has six-figure open interest. This is why, because it's in a Wyckoff spring. And when this springs up, remember, everything is going to fall down. So that right there is.
And just circling back everything all again to the very beginning, the past 40 something years, the debt ceiling has turned into a sell the news event.
Yep.
And
Yep.
it's not bias, it's just data that we're looking at, and we'll see how that turns out.
Yep. I'm looking at Apple right now. Right now,
Mhm.
I really want to get this across. Like, this is 2020. Right? Yeah, this is 2020. Gaps all the way down to $57.12. Listen to me real closely. Now, I know everybody wants to like make, money to the moon. I'm with you as well. All right. But I'm not for the gloom and doom scenario. We can make money on the way down. Do you know that I calculated the amount of movement it takes for certain stocks to move? So if you actually looked at the weekly chart, and well, I did the math by myself, but if you actually calculate for a year, for 12 months, right? So matter of fact, let's do the monthly. If you subtract the open from the close, and that's how much the actual stock went up or down, and you do that for 12 months, and then you add all those numbers together, and then you divide it by 12, you'll get the average amount that the stock is going to move per month. All right. So I did that. Oh, free game, by the way, pro tip. Like, so did that. And then I'm looking at the price targets of where I think the stock can get to. So the lowest target is $57.12. So let's say you think that the stock is going to move you know $20 per month, right? That means that it's going to take 9 months for the stock to get to your whatever price target or whatever, if it's going to take 9 months. Like, so you can look at that and do the math on your own. But if we look at the price of, let's say, next September for the 50s, it's $31 for next September, because nobody thinks it's going to happen. It's $31. Anybody that has patience can learn from Warren Buffett, because he made his money from patience. He didn't make it quick buck every week. It's like, okay, if I'm confident that this market cycle might take a turn for the worse. Even if you don't want to go way down there, you can actually just hit it at the 111 on time frame or price target. But literally 1, 2, 3, 4, 5, 6 gaps, they're not going to just let that go. It's just not going to happen. So you can literally get let's see, September 2024, 50 contracts, 50 strike contracts for the lowest you can get them is $19. $19 for a year and a half out. You only got $100. You only got, let's say you got $1,000 because tax season just passed or whatever. You only got $1,000. You only got $500. And I know Apple just started this 4% savings account, and then they have a huge announcement that they're making and things of that nature. Cool. But if you just want to put $500 to the side on, let's say, the September or let's say the December 50 contracts, and you're able to get a couple of them at the money, it's $1,700 per contract. So for me, looking at not just trying to go and get rich overnight, but looking at the rational explanation of what might happen. Let me see what chart I had this on. We're looking at both ways. So if I go to the analysis, if I go to this chart, I have a target for all-time highs. So above all-time highs, I think that we get to 191.59. That's my next price target. I really think that above all-time highs, that's the next price target. It's probably going to pull back right there. But when we look at let's see, the 1 hour, was it the 1 hour? No, we're looking at let's do the daily, I think. All right, boom. When we look at the daily chart, what do we see? What do we see on the daily chart? A bump and run.
Mm-hmm.
And it's damn near perfect. Like the perfect consolidation right here from May 5th. Like, and you see my trend line right here at 174.54. Perfect. Perfect. Right. And then it went up that 45-degree angle for the bump and run. Bump and run is a bearish pattern, by the way. Now, this whole consolidation, when you see this highlight I have there, that was like the like liquidity zone. But we popped up above there because once again, NASDAQ was running. Apple is one of the heaviest weighted stocks in all of the indices. The Dow, or matter of fact, I think it's the Microsoft is in the Dow right
The
now.
biggest thing that I've learned too
But
in my years of trading is that they know everyone is targeting those areas of liquidity as well. And so
right.
they'll push things out of those zones to stop people out.
Yep.
That's how they stop people out.
Exactly. And when that's how they have to, get their contracts and their positions. So when you look at us going up here and tiptoeing on that trend line for the bump and run, once we drop below that trend line,
There's that really good clip that you sent me before as well, where it's an institutional trader who's been in the market for a very long time, and he says next time you go to enter a trade, pick up something heavy and whack yourself in the head with it, and where you had your stop loss at, that's where you buy.
Yep.
And
as
that's
you can
how
see,
institutions trade. Is they go is their entry oftentimes is where other people's stop losses are.
and as you can see with him, like he was talking about the bump and run. Look, it's identical. Identical. Just to give you like an example. So when we look at that, that is what I feel like is going to start this drop. That's what's going to start this drop. It's hard to look at right now because
They've got some nice gap downs on Apple too on the daily.
Right. It's hard to look at right now, but that's what we're seeing. And when we go to, I hate to do this, but NVIDIA, when we look at NVIDIA, we got a gap at $54, $150, $211. Now, a lot of people are going to say, we don't look at gaps like, we don't look at, everybody trades differently. Okay. Everybody trades differently. But when you're looking at these gaps and then you're looking at other things, it's the monthly chart. But if you go down to the daily chart, you'll see a lot more going on. So you'll see, okay, we gapped up.
Bro,
All
I
right,
mean, that looks like such an island top forming right now. Island top
right.
reversal. We're really just waiting for the gap down. As soon as it gaps down, bro, that's confirmation that the island top reversal is in.
But peep this, it already gapped down. So there's so much going on. So I kind of want to point everything out. So when we look at I'm gonna go from this time frame and then I'm gonna go to another chart that I have. So we're just looking at the daily right now. So this gap right here is a breakaway gap. All right. Breakaway gap, meaning it's probably not going to fill immediately. We're going to go up a little more. All right. So that breakaway gap had an exhaustion gap above it. All right. So the exhaustion gap, matter of fact, no. Actually, this might be a runaway gap. So the runaway gap was letting you know, hey, I'm getting a little tired. You know, that's my analogy. Like, I'm getting a little tired now. The exhaustion gap was like, hey, I need to take a rest. The exhaustion gap was right here. We gap down. So when I go to the 4-hour chart, you'll see that we already have that island top reversal. You just can't see it because boom, that gap right here. And on the daily, this would be a gap. So when we look at the daily chart, you'll see that it gapped down on the daily. So whether you want to call that an island top or if you just want to call that a shooting star, let's say that's a shooting star. But
That could be a dumpling top, bro, too.
but check it out though. Check it out.
A
If you go on
dumpling
the weekly
top.
chart, if you go on the weekly chart, and then I switch this over to uh hold on. And then I switch this over to default. Boom. Now, what I call this is a bump and run because we got a bump and run right here, but it created another one on the weekly chart. This right here is an evening star. All right. So on the weekly chart, this is an evening star. What that means is if we get this week a candle going down bearish, that's all she wrote. It's an evening star formation, which is a bearish formation. That's within a bump and run, which is a bearish formation. Also, we also have the gaps that we mentioned on the daily showing exhaustion, So not to say we can't go higher, not to say we don't like NVIDIA. Like, yeah, I think NVIDIA is amazing, right? I think NVIDIA is amazing, but when we look at the monthly chart, you'll see that it is
You want to know something wild too,
overbought.
bro?
It's overbought. What's up?
Kathy Woods, uh, split adjusted, got into Nvidia at $5, bro.
Oh, that's
And
genius.
people been trying to trash talk her for selling Nvidia. I guess like before earnings, But
She was sitting on money.
it's like, okay, so she got into it at $5 and sold it at 300, and then the stock went to 400. But like, I mean, bro,
She was sitting on money.
can you imagine getting in the stock at $5, bro, and it freaking
Yep.
runs up to $300,
We will.
$400?
We will because all of these stocks are going to be on sale. It's going to be like going to Nordstrom Rack, but if Nordstrom Rack was the dollar store, but the dollar store was going to turn back into Neiman Marcus. That's what's going to happen. We're going to be shopping at the dollar store and knowing in 5 years it's going to be, or 3 years, or however long, it's going to be Neiman Marcus. All we got to do is just keep the clothes. So when we look at this, it's looking like a bearish divergence, clear as day. So it's not only us looking at one thing and saying, we're going to short it. Nah, like it's a bearish divergence here. We got a bearish bump and run pattern. Also, we have an evening star form, or I'm sorry, shooting star formation right there. If we look at that as a one, a singular island top formation, and all of these people that are saying we don't look at patterns and stuff like that works for me. So we got that big gap down to 306. If you want to ride that down, I would honestly go a few weeks out, maybe a month or two or more, because it's early right now. It's hype right now. Everybody thinks it's going to the moon, but when we look at the golden sweeps show it's millions of dollars going into puts. So when we look at the evening star formation, just so we can show you, we're looking for a bearish candle for that next month. For the next week, actually, for NVIDIA. So when I go back to the weekly chart, that's what you saw. The evening star, the gap up. All right, on the weekly, the gap up, and then the bearish candle. And then we're looking for, once again, 120-something billion in T-bills might affect NVIDIA as well. So we might have some bearishness. We get that bearishness is going to confirm everything that we're seeing. So we're looking at that.
I want to go
And
ahead and go into gold real quick too while we're talking
okay,
about tech
go
so
ahead.
much. I've got some good
You can share your
gold and
screen.
tech charts that I want to go over for people. Um, so gold hasn't been looking the best for me right now. All right, but I'll go into it a little bit more in the next chart. But one of the ways that you want to look at gold is let's say you're trying to have a diversified portfolio, okay? And you think that tech has run up a little bit too much. Maybe you want to get some gold, okay? They typically tend to move in a negative correlation. I'll explain that more in another chart, but I've had a lot of people on YouTube talking to me about gold or commenting about gold. If you look at the GLD SPY ratio chart, we had this very massive move down into 2022, right? During essentially the COVID bull market. And we saw, equities and stocks really outperforming gold, right? And all we've done is we came up and we really put in a triple top only at the 38.2% retracement level. Now, when you keep getting rejected at the 38.2% retracement level, that's very indicative of a strong trend, right? And so this strong downtrend that we had, if we would have retraced all the way up to the 61.8, that would have been more indicative that like, hey, there's a chance we can consolidate and break out and maybe even get a reversal here. But we're seeing it, right here, right here, right here, nice triple top forms. And we had this rising wedge, and to me, this was a big warning sign. I was posting these charts and these videos on gold, back when we were right at this area, and I said, we got this rising wedge, here. To me, it looks like we're definitely going to come back down towards the bottom of the range. Now we are back at the bottom of the range. Okay. Since 2022, when the bear market started in the stock market, you can see that gold really has been outperforming the stock market and overall is in a bullish trend. But we're back at the lower end of this channel here. So, if you're looking for sometimes to potentially get back in gold, I don't necessarily think that now is the right time, but from a risk to reward standpoint, we are kind of approaching these levels here where it does make sense to, maybe perhaps get in some type of gold, have a tight stop loss down below, and, you can cut your losses quickly. And if it works out right, we could see another move back up. Now, being that we put in a triple top here at this 38.2 retracement, the likelihood that we break through that trend line is stronger. So, I am watching gold a lot right now, but it's not my favorite chart. This is a really good one that shows you guys. If you take a look at the gold tech ratio, so what we have on top is GLD divided by QQQ. So this is the gold tech ratio versus the SPX. The big thing that you want to take away from this chart essentially is that they're going to move in opposite directions, right? So when we see gold outperforming tech, right, we see the stock market dropping, right? Same thing over here. We see gold outperforming tech, we see the stock market dropping. Okay, over here we see the stock market rising and we see tech outperforming gold, right? That's what's going to happen when this ratio chart is going down. And the only time when they have both traded in the same direction, when the S&P and the gold tech ratio both went up, it actually led to further bullishness in the stock market and a pullback in the gold to tech ratio. And I've been mentioning, you're not going to want to really try to get in gold, okay, unless you're trying to diversify your portfolio and perhaps add some type of a hedge. If you're exposed a lot to tech, you're not really going to be starting to look for it until you start to see the stock market pull back. So we've talked about a couple scenarios where the stock market could be potentially pulling back, and maybe why it would pull back. And if that does happen, historically, what you're going to see is you're going to see this gold tech ratio start to rise, and you're going to start to see gold outperform tech. But lately, really since January of this year, tech has just been on an absolute bull run. And it's no surprise we're seeing gold pull back even after it just hit all-time highs. If we take a look here, things pretty much played out perfectly for me, honestly. I mean, this is the GLD daily chart. All right, we had this very nice cup and handle pattern, posted about this a very long time ago. We got the very nice cup and handle breakout. And then we got a bullish 5-wave structure, and we came right up to the area of liquidity, as Leon talked about earlier. You can see as soon as we hit that zone right here, this was our major area of liquidity, our supply zone there, and we hit all of our bullish price targets. We've started a pullback. And, I like to use the fibs a lot because it helps you identify trend continuation versus reversal. So over
That
here, when
dumping
we were
top.
in the downtrends, we had a downtrend, retracement, continuation, retracement, continuation, retracement, continuation. And then we consolidated here, broke through the fibs, flipped it to support, and we started a 1, 2, 3, 4, 5. And each time we came back down below, we ended up pushing back up higher. So GLD has two gaps down to fill. And to me, what we have is a rounded top right here. Okay, similar to when we had the rounded bottom here, that's a bullish, bottoming signal. And this is a bearish topping signal right now. So I'm still not really looking to go long quite yet in gold. It's something I've definitely been paying attention to and waiting for the pullback. A lot of people were asking me, in this time period, like, oh, should I buy into gold? Should I buy into gold? And I'm saying, we're at least due for an ABC correction to the downside at bare minimum, right? If we take a look at the futures chart, I had this charted up as well. And these are not new drawings, okay? These drawings have been here for months. And, I had it topping out here at this area of liquidity. And you can see we came to that area of liquidity. We finished the 5-wave bullish structure, and we've already gotten an A wave down, B wave up. The B wave could continue a little bit more up to 2011, but it seems like we've already topped out on the B wave after this really big bearish engulfing candlestick. And, the gold futures could be at minimum headed down to about 1876, 1916. Are really going to be some of the key areas of interest for me. And if we end up breaking below these levels and flip those to resistance, most likely we're going to get a larger reversal. Now, we do have this initial bearish divergence trend line. Leon mentioned bullish divergence and bearish divergence a couple times. But just to re-emphasize, take a look. We have these highs, these higher highs, these higher highs. So, the price of the stock, of the gold futures is clearly in an uptrend here, right? No secret about that. It's making higher highs. Meanwhile, we're continuing to create these lower highs here with a high, lower high, lower high. If we break out of this bearish divergence trend line, okay, that could be an entry signal, right? If we break out, flip this to support from resistance, even if we just move sideways and hug the trend line or continue heading higher, that's going to be a bullish look for gold. Now, if we get something known as a look above and fail, that's going to be a very bearish signal. And the reason that's bearish is because let's say we do break out of here, and rather than retesting that trend line or hugging the trend line, we actually get a false breakout, a look above and a fail, as I like to call it. The reason that's so significant is because at this moment right here on the breakout, this is the bull's chance. This is the buyer's chance. This is the time when demand needs to step in and buyers and bulls need to show that they're in control of the price action, and the bears aren't. And if they fail at that, what it's going to show you is that that was a false breakout. Bulls are not in control at all. It was a liquidity grab, and bears are the ones who are in complete control. So that's why these false breakouts, whether it's a look above and fail or a look below and fail, are really significant, because it actually tells you who's in control. And you can determine all this stuff by simply looking at the price action alone. And it's been making sense. All right. I mean, we everything's following, Elliott wave theory right now. We came up, we hit a 5-wave structure. We're due for an ABC correction. All right. We had a wave 1 down. We're in that wave 2 process up. It could go up a little bit more, but ultimately we're going to be looking for another wave 3 down, at least to 1876 or 1916. And that's when I may be interested in going long on gold. And your risk to reward, perspective, your risk to reward ratio is going to be much better down at these areas. Okay, and you put a stop loss down here, or maybe even you enter here and put a stop loss here, and then you're going to be targeting new highs, okay, up to here to your bullish price targets, or even the prior supply zone there. That's a good looking risk to reward ratio where you're risking about 80 points on the futures to potentially make 100, if not 150 points. So you have a much better ratio than trying to enter in here in indecision. And then let's say you get shook out and it comes down, and then you see it continue a bullish rally, or maybe you're trying to short things here. And it ends up bouncing a little bit, and then we break below those key levels. There's a lot of things that you want to be careful of, okay, and really, kind of understand price action and what's going on in the markets a little bit more. One thing that I've been telling a lot of people too, who were trying to short gold or Bitcoin, is gold and Bitcoin actually trade more similar to each other than gold and tech or Bitcoin and tech. Okay. A lot of people will say, oh, well, Bitcoin and QQQ and yada, yada, yada. To me personally, gold and Bitcoin are the ones that you want to pay attention to, right? When we see gold futures here bottoming out, we shortly see Bitcoin bottom out very shortly afterwards. And then they both went on this very nice, massive bull run. And what I'm wondering now is if Bitcoin is going to be a leading indicator for gold, right? We can see that gold essentially is holding up this support level here from late March, very early April. Gold was able to bounce off of this level. Okay. Meanwhile, Bitcoin actually broke through that same specific level and it's actually testing it as resistance right now. So we have a very textbook breakdown flip to resistance. And if we stay below this level here on Bitcoin from these early April, late March lows, that could be a sign that gold is actually due to break down even more. So, we're seeing rounded tops here, as I mentioned before, on the GLD chart, as well as the gold futures chart. I don't like to see these rounded tops. Okay. It's very, signals to me just how a rounded bottom will oftentimes signify a bottom. These rounded tops look like a topping signal, a topping pattern. And that brings me into Bitcoin a little bit more. Now, Bitcoin has been, another thing that followed the analysis really well. Okay, we also had essentially a nice structure here. Okay, where you see again we're bouncing off of the fibs. We retrace, continue that trend. We were able to hit our bullish price targets. We had this bearish divergence that we've been forming and that has really started to pull back on Bitcoin, but it's still holding above its 38.2% retracement level right now. So we have the big move up, we have the retracement, and essentially the way you use the fibs is nothing moves in a straight line down, nothing moves in a straight line up. You either get a move up retracement continuation higher or move down retracement continuation lower. So you can use it to spot that trend continuation as we did over here, but if you start to see it move up, retrace, and you start to see it consolidate and break through those retracement levels, that's how you can spot that potential reversal, right? And over here, we got a clean move up, retracement, and then very quickly continue the trend. Since then, we've moved up, we've retraced, and we're just consolidating right here, right? So, this doesn't lead me to believe that we have lots of strength. Now, could we consolidate more and eventually push up? That is possible. But ultimately, it looks like we're going to potentially try to break through our major retracement levels here. Now we do have a big area of liquidity. This former supply zone here on Bitcoin, right around the 25,000 price target. This was an area where we were looking to go short, right? And we saw that we had a strong pullback there. We had the higher highs, we had the lower highs, we had that bearish divergence. And I mentioned earlier before what you want to see if for breaking out of a bearish divergence where we had the breakout retest and then we even just moved a little bit sideways, but ultimately that was bullish because we didn't get a look above and fail right here on that initial breakout of the bearish divergence trend line. So this is a really actually great example of what I just explained on the last chart, where this is what you would want to see if you're bullish during a bearish divergence is notice how it really just went sideways, but the price of Bitcoin continued to go higher. So right now, what we're looking for is we're going to see, can it hold this 26,621 level? Can we hold 25,269? And can we hold 23,917?
Honestly,
If we break through there, then
real
most
quick,
likely
bro.
we're going to come back down to like 19,000, 20,000 at least.
Real quick, I'm leaning towards the downside of what you're saying because what I see on my chart for Bitcoin, Bitcoin has a gap at $20,090. So that's right where your liquidity grab is. That's pretty much exactly where your liquidity grab is. So I'm thinking it breaks that 61.8 and heads down there, just judging off of the chart that you have drawn
Yep,
up.
and that's what it's consolidating here, and boom, that's not what you want to see. You want to see the move up, retracement,
Mm-hmm.
continuation higher. Once you start this retracement and consolidation, the likelihood increases that you break through there. And we have the bottom of this channel right here. That we had the liquidity grab at this moment, kind of a fake out, right? And so I mentioned the look above and fail. This was a very textbook look below and fail, right? And so we came down here, we broke below, and instead of retesting the trend line and pushing lower, bears had the full opportunity right here to show that they're in control and push price lower. Rather, we saw that bulls were in full control of the price action, and this was merely just a liquidity grab, and we ended up making new highs and hitting both of the bullish price targets up above. unable to hit the bullish price target right around 32,000. But yeah, so I just wanted to go over gold and Bitcoin because I have a lot of people on my channel that ask me about gold or talk to me about gold, or I make a lot of crypto videos, and ultimately this is what I'm seeing right now on these charts.
I want to tap in on Meta and Google, and then I want to ask you a question about oil.
Okay, yeah, you should be able to share your screen.
Okay, so when we look at um, so when we look at Meta, this is going to be real simple. Meta, when we look on the monthly chart, actually we'll look at the weekly chart, scale it out a little bit. Weekly chart, it's the same thing we talked about with a lot of other stocks. 61.8% retracement. We go from the highs to the low of October, and we literally smacked right at that 61.8% retracement and we got rejected. It's literally cents away. I did this to the dollar. $272.89. It is at $272.61. All right. It's literally like 20 or like 17 points away. You know what I'm saying? So it's, if we look on the daily chart, we'll see a little more. All right. So we look on the daily chart, we got rejected, but where can we go back to? And I keep talking about these gaps because you're going to you're gonna look back on this and you're gonna be like, it might be something to that. Boom, it's a gap right here, right? We got a lower gap right there. And we're gonna make that red just because I want it to be red for bears. And then we got a gap right here. Boom. And we're gonna make that red again. Boom. All right. And what we see, those two gaps, when we look at the daily chart, you'll see there's divergence forming. All right. You see a lower high, higher high, higher high, creating that lower high right now. We get one bearish day, it's a wrap. That bearish divergence is there on one more bearish day. Pretty much there. But let's just scale out to the weekly. Do we see something on the weekly? All right. Let's use everything. Oh, would you look at that? It would be a bearish divergence on the weekly too. On the weekly chart too. Higher. This is lower. Lower high. Higher high. So this is everything that we're looking at. And matter of fact, let's just go ahead and add this volume in there too, because we see that
Putting
declining
on
volume
a
happening right there.
triple top on those stochastics right there too.
Yeah, triple top on the stochastics, and we know that triple, it's actually more valid for a reversal, or a triple bottom more valid for a reversal to the top side. So exactly what Zach said, we got that happening. One more bullish day or one more bullish week, however you want to put it, starting off at the day, scaling out to the week. We got another drop coming, and where could it go with this declining volume, showing that that rally wasn't real. That shows that we possibly, when we scale down to the daily chart, I would tag that first gap right here. So that's around the $209. That is 70, pretty much $60, $70 below, right? That's going to be dirt cheap. If you get that a month out, 2 months out, that's going to be dirt cheap.
Bro,
You
and
got,
there's millions and
matter of
millions of
fact, we could
the
actually
put
look at
golden
it.
sweeps, the golden sweeps that came in on Meta, bro.
Yeah, Meta and Nvidia, like literally all the tech, everything we're going over with you. Google has some golden sweeps. So we're going over all of these things with you because big money institutions, they're not going to tell you. Like, I respect everybody that is an economist and that is an analyst and everybody in that field. But we know why they're not going to give us the chat GPT that can pick stocks and do all those things. Like they're, like it's certain things that we're going to get and certain information that we're not going to get. We're just going to have to come to the realization ourselves. So when we look at Meta, $200 away, or the 200 strike, let's see, September. Let's say September, because that's the first gap. All right, 200. That's $250. Now, what is that at the money? 2,000. You would spend $250, and looking at the chart, it's right there. It's right there. It's like a couple days away. And when you look at what Zach said earlier, as far as how the market reacts after the debt ceiling agreement is or the debt ceiling is passed, And we got $123 billion of T-bills being, auctioned off on Monday, $1 trillion in T-bills being auctioned off in the month of June alone. Federal Reserve is not buying any of those because they're like, we're trying to get some stuff off of our balance sheet right now. We ain't got it right now. They got it, but they don't want to spend it on it. So that's going to be for basically it's going to suck liquidity out of the market, and this might drop to 200 quicker than you think. So you got a September expiration for $200, the 200 strike, and you got it for $250. You're at your strike this week or within 2 weeks, and you got months. You might make $10,000 if it drops way down here to 150. All right. Matter of fact, let's do that math right now. So if it drops to 150, let's do that math right now, right in front. This is how I do it. A lot of people have like calculations and a table they do. This is how I do it, and it's been accurate. You just can't do it one time. You have to do it as the days get closer. Your price might diminish a little bit, but here's what I do. My strike is 200. All right. So it's $250 right now. As it stands, if I get to my strike, my contract is going to be worth $1,950. I paid $250 for it. I made $1,700. All right. Now I get to that strike in 2 weeks. All right. I got months, right? So let's say it gets to 150. 5, 10, 15, 20, 25, 30, 35, 40, 45, 50. Because 200 minus 150 is $50. So that would be $50 in the money, right? So on $50 in the money, how much is that contract worth? $5,235 from $250 in a YouTube video and some patience. So imagine if you spent $1,000 on that. You got 5 figures off of $1,000. You'd have made over $10,000, $20,000, $30,000 off of $1,000. So that's just literally a week or two of the things that happened in the past: 2018, 2011, 2002, 1980, I think 1984 or somewhere around there. Like, it's literally cyclical. So when we're looking
A
at the
lot of
weekly
people
chart,
just aren't going to be ready for stuff like this, bro. It's just,
yeah.
but I mean, when you look and we looked over the past 40 years, bro, the debt ceiling has been a negative impact, right after it happens.
Mm-hmm.
We've seen drops as big as 20% in the S&P. I mean, that's going to be a lot bigger in individual stocks.
Yep. And I forgot which, I had it on intraday. All right. So when we look at Google, it's going to be my last one. Google, let me adjust this a little bit. All right. So when we look at the daily chart, it's going to make sense. Bump and run, and it's already broken. It's already broken that trend line on the bump and run. There we go. All right. So bump and run, as you can see right here, that's that consolidation. And then we ran. All right. That's a 45-degree angle. Created a gap right there, as you can see, bearish gap. And then we broke that trend line, retested it, gapped up, retested it, couldn't do it, created a abandoned baby, still couldn't do it, still couldn't get above where we needed to just get bullish. We're trying to get bullish, we couldn't do it. So we're just consolidating literally for since, what is this? Since April or since May 19th, we've been consolidating sideways on Google. Now,
you remember what we used to call this back with On Earth?
Nah.
Candle constipation.
Oh yeah. That
candle constipation, bro. That consolidation candle constipation, bro. That shit could be ready to dump.
it is definitely ready to dump. And this is one of the top stocks that's actually pumping as well with the AI boom. But as you know, me and Zach have been saying, it's definitely a bubble. It's definitely a bubble. It's gonna recorrect itself like everything else does in the market. But anything AI is hot. People are just mentioning it in their, earnings calls, just to get some hype to their stocks. It could be like, Dollar Tree, yeah, like, yeah, so we got this AI that helps us pick the groceries that they just want to say it just to say it in the earnings call. But if you see right here, we got that box consolidation right here, letting us know we're in a consolidation zone. So we're using everything that we know. We got the bump and run. Not only that, we got the bearish gap. Not only that, we got a huge bearish divergence right here. If we talked about that earlier, you'll see higher low or higher high, lower high. Right here, lower high, higher high. All right. Right here, lower high, higher high. You see that? It's clear as day on the daily chart. So even if we scale out to the weekly chart, you'll see the same thing forming on the weekly chart. You see it's almost, let me erase that. It's almost crossing on the stochastics. So like, once again, we're like a day away or a few days or maybe a week away from everything just dropping. And it's not like me, saying this doomsday scenario. It's like we can make money while this happens. We just showed you Meta. Zach just showed you, gold, Bitcoin. A lot of people trade Bitcoin futures or like, Bitcoin on Forex and things of that nature or crypto. Like there's certain ways you could trade Bitcoin. I know some Forex platforms that enable you to trade Bitcoin. And like it's the information is out there. So my target would be $20,000.90. He showed you his targets for the 61.8% retracement, 50% retracement. If we scale down, lastly on the 4-hour chart, we'll see we're possibly going to create an island top reversal. All right, so the possible island top reversal, you see how it's squeezing right there. And if we get that gap down that I'm expecting tomorrow on the daily chart, that would be an island top reversal because there's a gap right here. We gap down right here. That's that island top reversal. And it's just another sign that it's going to go down. So that's literally like more than 3 or 4 signs that certain stocks are going to drop. Not one, specific way of looking at it, multiple different ways of looking at how it can drop. But we only have like maybe one way of how it can pop. All right.
Yep.
So we're looking
So
both ways
I've
across the street. But what I wanted to ask you,
mhm.
how do you feel about, OPEC? I mean, they didn't say anything about, the stock market. They didn't say anything about the market today, I believe. But how do you feel about OPEC? And how do you feel about the Saudis with the oil situation that they have coming up?
Well, I know
They
de-dollarization has
didn't
been a
say
really
any
big
market
theme.
related. So
De-dollarization has been a really big theme. Okay, before the debt ceiling, that was the big thing on the news headlines, right? And I do have to say that I agree in a general sense with de-dollarization. And global currencies, they go through this. Okay, this is what happens. Like they don't last forever. They're not going to last forever. And do I think that the dollar is going to go away, as far as being the global currency very soon? No. But do I think 10 years from now it's very possible that something replaces the dollar? Yeah, for sure. And what we're seeing now is just a lot of stages of that. We have all of these different countries starting to trade commodities in their currencies, or even the Chinese yuan, which doesn't look great. And we're starting to see a lot of different stuff like that. And we have the BRICS, all right, and more members have been getting into BRICS. It started off as a much smaller group,
right,
and now the Saudis are even talking about joining BRICS. Okay, as Brazil, Russia, India, China, and many other countries. And what they're doing is they're trading in their local currencies, not the US dollar. So that doesn't look great for the dollar. And they're meeting right now. I think that it's a lot of people are expecting them to announce oil production cuts again. But here's the thing is that let's say even if they possibly do, it might not really be a bullish case for US like USO, okay, United States Oil Fund or United States Energy Sector, as people are anticipating it to be. And, some people think that maybe, they're even just testing OPEC with these really sharp drops that we're seeing in energy. And we're seeing copper dropping a lot right now. Okay. Typically, when you see, copper tanking like this, it's signs that, we could be heading into a recession. Um, and so energy is very similar to gold to me right now. It's just not at a clear point of, hey, are we just getting a healthy pullback to continue going higher? Or is this about to be a very big drop to the downside? And, last time that energy broke down, we had OPEC, because we had OPEC to save the day, really. And OPEC came in and gapped energy prices up much higher. XLE gapped way up. And we had initially broken that trend line that you had there, that purple trend line. And now since then we've fallen back down below. And it doesn't necessarily look good for energy. Now, of course, energy and tech are going to run separate of each other. So, tech has been absolutely skyrocketing right now, and it's no surprise that energy looks like complete trash. So if the market does flip, okay, and we start to see tech really start bleeding, there is the chance we could see an inflow back into energy. And maybe that would also be boosted a little bit by seeing, maybe an OPEC oil, production cut announcement. But to me, what's scary right now is that's pretty much the bull thesis for energy, is strictly relying on like OPEC to be like, we're doing more oil production cuts. I mean, that's not generally a really good investment strategy, right? I mean, that does tend to be a bullish catalyst whenever they do these oil production cuts. But people aren't investing into energy and necessarily waiting on OPEC the entire time, right? They're investing in energy for different reasons, and then that oftentimes just will be a catalyst that helps the price of energy. And they
So check it
really
out. Hold on.
typically only do that to control price, right? When price is getting too low, that's when they do those oil production cuts. But they're going through it with the US right now, right? And they may not want to come in there and step back in again and really announce that they're going to do oil production cuts. The CME watch tool for the odds of whether they're going to do nothing, whether they're going to do output or input increase or decrease, it's at like an 80 something percent chance that they're not going to make an announcement, basically.
So hold on. What do you I understand everything that you said. Now, do you think that, Warren Buffett and his partner increasing their position in their energy company has anything to do with people also creating that bullish scenario for energy? Because they just
Well,
recently increased their position as
he
well. And they
he's
damn near own the company right now, but like they increased their position in the company just a couple weeks ago, if not like recently.
and so pull up Oxy real quick. I want to show you. Pull up Oxy on the weekly time frame, and I'll show you where Buffett's been buying. Okay. Buffett has been buying at $60 for the past few years. Okay. And so if you take a look, it's back here below 60. I mean, that's generally his average cost basis. And he's not a short-term investor. He's a very long-term investor. And what he likes to do is he likes to buy companies. Okay. So he buys so many shares that he pretty much owns the company or has a large say in the company. And that's been Buffett's price zone is below $60. So it doesn't surprise me at all that he's been buying it below $60 when it comes to Oxy. And that's what we've seen here, more recently, right? If you go from like really from 2020 to now, versus like, that's like 10 something years ago, he's really been buying, within the past couple years. And you can see, the price level has really just been consolidating here since 2022, right around that $60 price level. And that's just he's buying $60 or below. So it doesn't really surprise me that he's, getting back in at where he thinks that the company is a good long-term value. And energy companies do look good from an earnings perspective. They have been looking decent, but of course they're going to trade according to the price of oil, and the oil futures and things like that are going to move around the price. But if you look in the past few years, there's only been a couple times really where it dipped below that $60 price level. And, that's really been, again, his area where he's been, buying a lot. So, I mean, seeing
No,
where
that's
the price
actually
of
that's
Oxy is right
true.
now.
2008 right there when it dipped below. That's like the last time, 2008, and then over here
Yeah,
in
and I'm pretty sure he bought a
2018.
ton in COVID. When you can see that huge dip
Down
there in
here.
energy. I
Yeah.
mean, he bought a ton there, but really since
Okay.
2022, and I think late 2021, that's where people have had a lot of attention. And started noticing that like he's buying a crap load of Oxy. And it's really been around that $60 or below. So, you know, that's the way I see it. And he got approval from the regulators and the people that he needs to basically buy more Oxy. And that's what he's gonna do is he's gonna try and buy as much as he can. And he's kind of set his price level on it of where he wants to be. As I mentioned, we could see energy go up if energy and tech have a different relationship with each other, an inverse relationship with each other typically. So we're talking about possibly seeing a big move down in Google, possibly seeing a big move down in Nvidia, and different things like that. We may start to see energy rally again. I mean, that monthly time frame, it does look a little bit like we're bull flagging a little bit.
Mm-hmm.
You could try to say that that's a bull flag. To me, yeah, again, I'm seeing a lot of rounded tops there. I generally am not the biggest fan of those rounded tops, but you could say that that's a nice little bull flag we have forming on the monthly chart for Oxy. So, it doesn't really surprise me. I mean, he's not going to change much of what he's doing. He's just going to continue doing the same things. And right now they're buying lots of treasuries, buying lots of T-bills. And he's got his companies that he's focused on. And Oxy is definitely one of those companies, that he pays a lot of attention to right now.
And lastly, yes, man, I like that whole take. We could look at the fundamentals on Oxy, whether it be annual or quarterly, and look at the ROE and the P. But like nobody can tell me that Warren Buffett don't look at technicals at all. Like, because if you look at this chart on the monthly, or however his fundamental analysis is, that shit is fucking spot on. Because all of these dips below 60 are pandemics. They're not like just a regular run of the mill, like, okay, no, it's like 2008, 2009, 2018, there was a big, drop. Um,
And
going
2020.
into going into 2020, big drop. So when Zach is talking about could be another rally, like we might not ever see 60 again until some shit happens. And it's like a light bulb went off when you said the 60 range. And I was like,
No, I've
yo,
been paying a lot of attention to it, and that's his
yo.
buy zone is basically right around that $60 level. If it's dipping below $60, he's getting into it. And when you just zoom in like on a 1 year, 1 day chart or like a 2 years, 1 day, you can see it really hasn't gone below that $60 price level for very long. There's been a couple times where it's gone down below and that's been a really good buying opportunity. And then it runs up close to $80. Then we start to see it pull back right around that $60. And then it pulls back down again, and then it runs back up, right around that $60 price range. And $60 and below is what Buffett has considered to be a good long-term investment in the company.
I like it. And then on the monthly chart, that's like for years it's gonna go up because you know how charts are. So yeah, that's a light bulb right there, man. That was a great episode. I have anything else? Like you have something else?
I'll just say that energy doesn't have to mean as much bad news as it used to mean for the stock market anymore.
Mhm.
And the reason being is it's a larger weighting of the S&P 500 now.
Mhm.
So energy going up can actually help the stock market, the S&P 500 go up, right? It doesn't have, it doesn't necessarily have to mean that the stock market is doomed. I believe that the S&P 500, like market cap wise, energy is about 5% weight.
Mhm.
But from an earnings perspective, the energy sector, last time I checked, is about 10% of the S&P 500's earnings. So, from a fundamental standpoint, which is, what Buffett is very known for, his fundamental analysis, you're seeing, an overweight it kind of in the earnings where it's like, okay, well, this is holding up, 10% of the S&P 500's earnings, but it's only valued at a 5% market cap. You know what I
Mhm.
mean? Or like or market cap weighting towards the index. So, that's one thing is energy doesn't have to be as bearish for the market as it used to be, due to, the rebalancing and the reshifting of the market structure and the reweighting of the indices. So I just kind of wanted to throw that last little gem in there.
Mhm.
Now, we went over a lot in this video. It's very long, but let's kind of recap it. So in the very beginning, okay, I showed you guys, a couple charts. We looked at some very important data. Let me actually go back to those real quick,
Yep. Yep.
and we'll kind of just do a brief recap and summary so that you guys can follow along. Okay, so what we did was we went ahead and we went over, all right, how tech is currently, trading at levels that we haven't seen in a very, very long time in the market. I think it's freezing up right now.
Mhm.
But yeah, so tech is valued at a 37% premium to the market. Okay. We haven't seen tech this expensive since between 1999 and 2001. We all know of the famous 2000.com bubble. And we can see here again, the S&P 500 is being driven by the top 5 stocks: Apple, Microsoft, Amazon, Nvidia, Google. All right, that's the white line. The blue line here is the other 495 stocks in the market, and it's actually been on a downtrend. Okay. Over here, we're seeing, AI sensitive stocks, the bots ETF has been going up, but retail flows have been going down into this. We talked about the price to sales ratio of the top stocks in that .com bubble, right? So again, we go here and we take a look at the last time that tech was this expensive was that 2000.com bubble. All right, we look at the price to sales ratio at the peaks of those companies. 38.92 was the peak of the price to sales ratio for Cisco, which was the most overvalued stock during the .com bubble. Nvidia at $37.92 right now, or 37.92 on a price to sales ratio, pretty much hitting, the peak, right? And this is after Nvidia has dropped a little bit, so it was a little bit higher right here, at least 38 or above. So, we're pretty much right at those same levels of the historic .com bubble from a valuation perspective on the price to sales ratio for Nvidia. But we're not seeing that in other AI stocks, right? We're
Mhm.
looking at Alphabet. It's got a 5.7 price to sales ratio. Microsoft has a 12.09 price to sales ratio. We look here at the S&P 500 pre-election year and aggregate cycle seasonal pattern, right? And we're now in this time period in June here where things could go up a little bit more, but really we start to get this consolidation in sideways period through October or November, right? So that's very possible. We've had this extremely large rally here recently, and it would make a lot of sense for things to cool off and consolidate sideways. But historically, these pre-election years, we do end up seeing a nice rally towards the end of the year through November. So we're going to see if that can happen, right? If we look over here, this is one of the big important data sets that we've been covering relative to a lot of the technical charts that we looked at. S&P 500 performance before and after the federal debt limit change since 1980 and 1990, which are the red and blue lines. This is the date of the inception of it being changed, and we can see 15 days afterwards it's been a sell the news event. The market has sold off for the past 43 years every time that we've gotten a debt limit change. And if that's going to happen, then we could see a lot of those bearish divergences and a lot of those bearish signals play out in the market, right? And then, we went over here. This was another warning sign. This is the S&P 500 versus the stocks above their 50 and 200 moving average, right? We see, each time there's been divergences where the S&P made lower lows, but the percentage of stocks above their 50 and 200 moving averages was going higher. We saw a rally, right? Over here, where the S&P is making higher highs, but the stocks above their 50-day moving average making lower highs. Stock market dropped about 200 to 300 points. And right now we have this huge divergence where we're creating these higher highs, but the percentage of companies trading above their 200-day and 50-day moving average has continued to make lower highs. So lots of warning signs to be cautious of in the market. You know, you don't have to FOMO into anything at the top. Maybe you're not a short seller and you don't want to short anything. That's fine. Cash is a position. You know, you don't need a FOMO into the top just because your friend made some money trading Nvidia earnings, and you know, now you're trying to get some of that money. That's how a lot of people get suckered into things. That's how a lot of people lose money. You know, we talked about gold. We won't go into those too much, but hopefully you guys enjoyed this video and learned something new. Again, if you guys want to help support the channel, use some of the links in the description or the pinned comment down below. And you can also email me, zachleytrades@gmail.com, for a coaching session. And you can also email Leon for a one-on-one coaching session. If you want to give them your email again.
ApollonEnterprises@gmail.com, APOLON Enterprises@gmail.com. And just to end it off, just a little timeline of what we were talking about as far as the S&P 500 and the debt ceiling. Once it got signed in 2011, July 31st was when the deal was announced. And then 2 days after that, August 2nd, was when Congress signed the deal, narrowly avoiding the default. And then on August 5th, the S&P was downgraded for the first time for their U.S. debt. So we had a 20% drop in less than 2 weeks. Now, what that looks like, SPX right now is at 42.82. A 20% drop over the next 2 weeks will put us at 34.25. That will put us below the October lows. And once again, in 2011, the drop happened pretty much the day that the deal was signed, or the day after.
It's right
so
after.
It was signed in on a Sunday. That particular Monday, tried to rally, sold off, continued to sell off for the next 2 weeks.
Yep.
So
I'd say that's the biggest takeaway is the debt ceiling has been a sell the news event for the last 40 years. And if that pattern was to continue, we could see that happen again. So we'll close out there. Appreciate you guys watching. Smash the like button, subscribe. We're out.